At a time of heightened geopolitical uncertainty, capital allocation strategies are being fundamentally reassessed, as we all know today. For family offices, institutional investors, and sovereign wealth funds, particularly across the Middle East, the question is no longer just about preserving wealth, but more about where to find resilient long term growth. And this is perhaps where venture capital is increasingly entering the conversation as a serious alternative asset class. For family offices, VC offers access to innovation and early stage growth that public markets simply can't provide today. For sovereign wealth funds, on the other hand, it is becoming a strategic lever, not just for returns, but for economic diversification and future proofing national agendas. But as we know, with that comes some pertinent questions around risks, around liquidity, around time horizons, and how to deploy capital effectively in a more selective funding environment as we are in today. So that's exactly what we're going to discuss today with all of us here on the panel and also our keynote speakers. Is venture capital still an opportunistic allocation on the margins, or is it becoming an essential pillar of modern portfolios? And I'm sure there is one person that we all want to hear from at this stage, and that is Rola Manneh, the Standard Chartered Bank's CEO for Middle East, UAE, and Pakistan. Rola, can we have you here now for the opening remarks, please?
Thank you, Shruthi. Good afternoon, everyone, and thank you for joining us today. We're meeting at a time when the investment landscape is shifting, shaping how decisions are being made across markets and how capital is being allocated. While the capital continues to move, decisions are being made differently. What has changed is not activity, it's the discipline. Client activity remains strong, businesses are maintaining continuity and progressing transactions while taking a more deliberate approach to positioning the day after. They are more selective, more risk-aware, and more focused on resilience, capital preservation, and long-term value creation. Now, this shift is also driving a more deliberate and structured approach to diversification. It is also reinforcing the importance of regions that can continue to attract capital and connect with confidence. The Middle East and the UAE in particular stand out in this context. The UAE's economy is increasingly diverse, its financial system is robust, and capital flows remain strong across key growth corridors connecting Middle East, Asia, Africa, and Europe. And from where we sit, we see and support those flows every day by connecting capital to opportunity and helping clients navigate both sides of that equation. That is increasingly shaping how capital is allocated, with alternative investments becoming more central, not as a trade, but as a structured allocation decision. Venture capital is a key part of this allocation, playing an important role in diversification while providing access to innovation and new sources of long-term growth. And our clients are approaching it with clarity, integrating it into portfolios with a clear sense of purpose and discipline. From a personal standpoint, I also see this development and progress through a practical lens. As a board member of some of the SC Ventures portfolio companies, I have seen firsthand that venture-backed businesses with the right governance, sponsorship, and strategic clarity can continue to show resilience even through periods of disruption while continuing to innovate, serve clients, and build long-term value for investors. With that, I'll hand over to Gautam, who will share a global view on the venture capital as an alternative investment asset class. Once again, thank you for joining us today. Over to you, Shruthi.
Great. Thank you very much, Rola. Much needed optimism in the current landscape, I might as well add. So, as you said, we are going to hand over to Gautam, who is going to give us more of a global view of venture capital as an alternative investment asset class. And Gautam, we are going to wait to hear from you. But just before that, for all the audiences who have tuned in right now, if you do have any questions for Rola and Gautam, please share them in the chat box below, and we'll try and take one or two questions before we head on to the panel. Over to you, Gautam. I think you're on mute, Gautam.
I think I'm good now. Welcome, everyone. Welcome to this webinar, and we are very happy that you have decided to join us. Let me start with something slightly uncomfortable. Venture capital is probably the most misunderstood asset class in modern portfolios. It is sold as an uncorrelated asset class that outperforms public markets. However, I think the reality is much more complex. Because venture capital isn't about averages, it is about outliers. One company can return an entire fund. Everything else just fills the space. And if you miss the winners, you underperform. And if you catch one, you redefine your returns. Venture capital is an asset class which remains with the highest rate dispersion, which means that picking the right manager is absolutely crucial for investors if they want to outperform public markets. In fact, the dispersion of return is such that over a 10-year period, a top 5% VC manager will outperform a median one by more than 2x. When we have seen that the top 5% managers generate north of 45% in annual returns, whereas a median manager will return close to approximately 13%. But what is happening in the market globally? What we are seeing in the market is that globally capital is getting tighter, but it is also getting more concentrated. For example, in artificial intelligence and digital asset infrastructure. Significant amount of capital is flowing into a handful of companies that already look like winners. So this is no longer an early stage experimentation. This is capital chasing inevitability, which means that venture capital is evolving from finding the next big thing to getting access before it becomes obvious. But let's bring it closer to home and let me give you a little bit of a Middle East context in terms of what is happening here. Because the Middle East, in our opinion, is playing a very different game. While global venture is recalibrating, this region in particular is accelerating. We see more capital, more deals primarily fueled by more ambition. Governments, sovereign funds, regulators, everyone is building. And the ecosystem in this market is very targeted, very visionary, and capital is being directed thoughtfully, aligned to the region's vision and goals. And that combination is really powerful. So while globally venture capital is becoming more selective, it's becoming more concentrated and more disciplined, the Middle East has become one of those few places where capital is still expanding, and it is expanding with real intent. Now, we all know that this region has seen instability in recent times, and while the short to medium term impact is yet to seen, it won't be zero. But however, the long-term trajectory is clear. This region will bounce back, and even more powerfully, as history has shown us. In the SC Ventures context, at SC Ventures, we sit at an intersection of finance, venture building and investing, and ecosystem creation. It gives us a very differentiated view on where venture-backed innovation is solving real financial and commercial problems, which gives us several significant advantages. Firstly, we are fully aligned to the region's vision and goals and remain committed to the region and continue to build our ecosystem through strategic partnerships, for example, with Hub 71, DIFC, DET, and others. Our bank-grade risk management and governance framework provides a very disciplined path to diversification, and our high-conviction themes have strategic, longer-term outlook. We continue to deploy capital. KeyRock, TrueFin, our digital asset fund with a global mandate, is continuing to deploy capital even through this unstable times. We have collaboration with ecosystem partners ongoing across Africa, Asia, and Middle East. And for SCV, this is not a pause moment. It is a conviction moment. We remain focused on long-term themes, deploying and building across Middle East, Asia, and Africa as a key part of our strategy. So the real question is not, should I invest in venture capital? The real question is, can I afford to leave it until it's too late? Thank you. And back to you, Shruthi.
Amazing. Thanks very much, Gautam. And Rola, just before we let you both go, we have a couple of questions. I think I'll take one for now and then leave the rest for after the panel. So I think the one question that I think right at the back of what you've just said, Gautam, would be that what makes this region, the MENA region, investable right now and not in the future and not someday, as is the conversations we've heard in the past?
You see, what is happening in the MENA region, as I mentioned in my keynote, is that the region is building with intent. There is a clear vision in terms of moving the economy in the direction of innovation, digitization, and becoming a hotbed for innovation across digital assets, financial inclusion, SME. This is therefore the right time when the build is actually happening. And what is very amazing about this region is that the gap between vision and execution is almost non-existent. What the vision is, execution is happening on those lines. And that is where it is an extremely attractive opportunity for VC money to come in.
Amazing. And Rola, just one more for you before we go. If you want to add on to Gautam's point, great. And also address the fact that there's a lot of Gulf capital that is being invested into VCs globally. The role that the Gulf money, Gulf capital plays abroad is also quite substantial. So if you can give us both these perspectives, that would be amazing.
Thank you. Well, definitely to add to Gautam's, we're seeing the Gulf is on a diversification and has been diversifying for many years now. And especially if we look at the UAE, its economy is diversified. And from that angle, if we look at the regulations over the last few years, it was to attract VCs and startups to come here and set up their businesses and basically to grow from here and create this region as a hub for them. So from that angle, and it is in line also with their strategy to attract talent as well and innovation. And when you speak about innovation, you speak about VCs.
Great. Thank you so much, Rola and Gautam. And thank you for your insights to open and kick off the session that we have today. I think now it is time for us to move on to the panel. And on the panel, we have Mohamed Fairooz, SC Ventures Middle East lead, Nader AlBastaki, Managing Director at Dubai Future District Fund, a VC fund of funds and investment platform, Philip Bahoshy, CEO of MAGNiTT, our go-to VC and PE insights platform. And we also have Benito, Mable, CEO of fintech firm Vault 22. Thank you to all the panelists for joining us. Just a quick reminder one more time to send in your Q&A, all your questions that you have into the Q&A box that you see on your screen right now, and we will be taking some of your questions at the end of this session. So I think Mohamed Fairooz, I'll start with you and I'll come to you to give us a global or a regional lens on capital deployment given the current situation we are in. And to just set the stage, if you can tell us what SCV's repeatable value creation playbook really means and what role do you as SC Ventures, but also how do you leverage the SC Banks network into the fintech ecosystem that we have today?
Thank you. Thank you very much, Shruthi, and pleasure to be part of the panel today. First of all, allow me to simplify my response here, and in a very short statement, I'll say that our playbook is about building impact-driven, innovative solution. Full stop. And allow me to repeat it here. Our playbook is about building impact-driven innovative solution. And what we've achieved so far, of course, would not been happening without the value creation and the partnership we have. And this is something which I'll elaborate more during this panel. But maybe as a start, and maybe just to highlight here that the journey starts with sourcing, right? And at SC Ventures, as mentioned by Gautam earlier, we focus on areas where we see structural gaps globally and in the region. To share some examples, it could be SME financing as an example, could be cross-border payments, financial inclusion, or even fintech infrastructure that supports real economy. Now, speaking about partnership, and this is how I've started my answer, and speaking about ecosystem, many players in the market treat ecosystem access as another buzzword, but in practice, it's very tangible, and we've seen it here in the region. It's quite very impactful. It's quite very effective, and what partnerships and ecosystem can achieve together is something which, of course, individually would be very difficult to achieve. And maybe live example to share with audiences, one of our new ventures focusing on SME, which we are building, it provides a very unique value proposition which would never happen without collaborating with like-minded partners. We believe in building nations, and we believe in our role in building nations. And as I shared as an example, our strongest ventures were built in partnership with some of our like-minded partners. These could be corporates, financial institutions, or even government-linked entities. Maybe to conclude here before going back to Shruthi, in today's environment, collaboration is far more powerful than doing it alone. And this is an open invitation to partners on the call, to stakeholders attending the call, to reach us out and to explore collaboration opportunities. Thank you.
Great. Thanks very much, Fairooz, for that answer. It does go to show what Standard Chartered has to offer in the VC ecosystem, and it's been very forward thinking as well, right? Even as journalists, when we follow the stories, last year there was an announcement of the SCV division to launch a digital asset fund coming probably this year. So it is quite reassuring to see all of the innovative ways that, ventures are being considered and seriously considered. Moving on to you, Nader, now. Today we are, as we know, over the last 7 weeks, the environment we live in is slightly different. As much as that might be an understatement. But the question would be, what does define an institutional quality venture opportunity in the current conflict environment that we are in today? And also keeping in mind that this is not the first crisis or the first recent crisis we have been in. So what are the markers that the global institutional investors look at, and what makes this region that much more investable today?
First of all, thank you for having me on the panel today. It's an honor. I want to address 2 things maybe before I jump into the answer. And the first one is what Gautam alluded to earlier, where we're looking at this asset class as not an alternative asset class. It's actually an essential part of what portfolios should have in terms of ownership, in terms of diversity, and also in terms of long-term views on portfolio makeups. And the other thing I want to address is, why is this question that you've just asked me very important? I think it's very important, given challenging times, to have leadership. I think leadership goes a long way when it comes to fund managers, when it comes to institutions playing their parts as part of the whole. And when we look at leadership, we want to look at governance when it comes to leadership, their clear structures, their transparencies, and their alignments to the opportunities that make them not just investable, but beyond the cycle that they're currently in, how they become an institutional part and an important part of not just this cycle, but the future to come, and the innovation that will allow for us to get there. The second part of it is how they play an absolutely important part to what Mohamed Fairooz was saying earlier around partnerships, around value creation, and how institutions play this a clear important role in repeatability of this value creation, not as one-offs, but looking at platforms that create playbooks, primarily fund managers that do so, that can constantly show their ability to source, support, and scale companies is an essential part of creating a healthy ecosystem. And the last part that I want to touch on is the continuity of capital. The ability to deploy and support companies through good times, through bad, through challenging times, through uncertainty, goes a long way in showing leadership and support in an ecosystem and that whole connectivity of that ecosystem and how partnerships play a role there. So overall, what I wanted to say here is that increasingly we see strong fund managers as critical. They don't just generate returns. They're an empirical part that provides sustained depth to the ecosystem. And ultimately, that's what institutional capital like ourselves is underwriting. We're not just underwriting those deals, those fund managers. We're underwriting the durability of that asset class in the ecosystem that we're in today. Maybe just to allude to briefly as well as people like Philip provide an essential part to that overall mix. His leadership in the asset class as being a thought provoker, as a data and a depth of data that it brings to the table also goes a long way in making it an absolutely healthy but a critical part of that asset class mix that we were talking about earlier that Gautam alluded to.
Amazing. Thank you so much, Nader. And now that you've mentioned Philip, I think I'm going to bring Philip onto the conversation. Even since the beginning of the conflict in the region, Philip, we've seen a lot of reports come out of MAGNiTT. I've seen at least 3 of them that's come. And I'd say my key takeaways from them would be that, you know, the reliance on international investors is proving to be a vulnerability today as we are seeing them stepping back or at least pausing operations. Capital is concentrating, as we've heard some of our panelists say it as well. And then the earliest pressure points are now being tracked very closely, despite the fact that, you know, the Q1 reports are quite strong and shows resilience. Things might change over the course of the next quarter. And this is something that we need to accept and be prepared for. In that context, Philip, what are the learnings that we have to adopt from COVID, and how do both sides of the equation, both investors as well as startups, sort of adapt to this changing environment, this conflict scenario that we are in today?
Thank you very much, Shruthi, and thank you very much, Nader, for the kind words, and Standard Chartered for having me here today. You're right. So MAGNiTT as a platform covers all kind of private capital, but focused on venture capital for emerging markets. And what we've been focusing on is trying to educate and advise our clients that things here are different to what you might have elsewhere in the world. So as you mentioned, we published several reports. One of them was kind of reviewing what did we learn from the COVID pandemic? And there is a lot that you can learn, albeit it was a completely different situation to what we're witnessing now. Number one, uncertainty, as I always say, is the devil of decision making. And naturally, at a time of uncertainty for investors, it slows that next investment round, that potential M&A transaction. And so what we were trying to identify is what were the trends that we saw that were most impacted from the current situation. We identified 5 specific pillars that may be impacted. Number one, international capital. 50% of all MENA capital came from outside of the region in 2025, with higher concentration in the UAE than other geographies. So the question is, will this international capital continue to flow? And what can be done from a government, from a corporate perspective, like a bank, to educate the international investor to continue to deploy capital into the region? The second, and we've witnessed this several times, not only in 2020, but 2023, when there was a slight slowdown, early stage capital is always less impacted than late stage capital. Last year, we saw progressive growth in later stage capital as interest rates were coming down, as international investors were coming to the region, as bigger bets were being made into the region. And therefore, what can be done to continue that momentum when there is uncertainty of that next investment round and that next exit? That comes on to exits. And we had already kind of orange or red flag coming into this year, the liquidity flywheel for the region. A lot is being done to encourage M&A transactions, a lot of conversation around IPOs here in the region, both of which, in a period of uncertainty, we calculated that 25% of all M&A transactions came from international acquirers, and 50% in the last 5 years of acquisitions were larger companies acquiring existing smaller companies in consolidation. While we're still very bullish, let me be clear, about the region, investments, and M&A, the question is that going to happen now, or does that get pushed later in the year and into 2027? And just to close out the kind of 4-5 pillars, deal flow is very important. And while I said the early stage is less impacted than late stage, the next generations of the funnel are driven by continuing to fuel the top of that funnel. So seed investments, accelerator programs, angel investors that may be impacted by the volatility in the public market need to continue to deploy in this asset class, which remains attractive for the next generations. And finally, it's the concentration of capital in the GCC. Clearly, with everything that's been happening, the GCC has been quite impacted, some geographies more than others. How do the fund of funds like Nader, who will continue to deploy into the local GP funds, how can they continue to attract international investors? And most importantly, and this is on the founders' side, founders need to operate and kind of navigate the challenges, but how can they share their pain points with VCs? And how do those VCs share those pain points with the fund of funds to be able to lobby and support governments in changing regulation and supporting the founders in this current environment moving forwards?
Thank you, Philip. Benito, I think you provide a very fresh perspective as well, given that you can be used right now as a case study, so to speak, right? So walk us through your incubation process, your go-to market, keeping in mind how things are quickly changing. And we know that, you've also, and now you're looking into this region, you're looking into the UAE as well. But the role that Standard Chartered Ventures expertise is played, being backed by them, and also SEBs, the bank's network, has helped with your operations and with your setup as well. So Benito, walk us through your process.
Certainly. Thank you for having me. And hopefully I'm coming through very much loud and clear. So as Vault 22, one of the ventures backed by SE, CVC, we've been lucky to be part of this ecosystem. So we sit very differently within the SE ecosystem, but more importantly, across the UAE as well. There's a massive ecosystem that is enabling our growth trajectory. Now, when people look at this vertical, it is typically framed as high, but when we look at a venture like us as part of an ecosystem, our starting point is really real problem statements from institutions and also the clients they serve. So we're not really starting from zero. We have tangible things to go at. So there's an element of validation that's already built in to the problem we're trying to solve. But building is different for us. Why? Because we have access to the problems. We have access to an ecosystem that allows us to experiment faster. Governance is usually day one, so we cannot afford to start to build more with the risk perspective. But what that means is through the incubation process, we are regulatory ready, we are investable, and we are ready to tackle the problems that is ahead of us. Now, from a go-to-market perspective, obviously, the challenging environment in the recent past means that we've had to, pause and recalibrate. Some of my panelists are mentioning the resilience from COVID. It is operational for us. We built that in from day one, but it also allows us to leverage access to the wider platform from the ecosystem, to know that from day one, we have business continuity plans in place, but we're also taking cues from the market in terms of how we proceed, how we market, and how we really pursue growth. We happen to have geographically dispersed teams. That also brings in the perspective, but staying close to clients, partners, and investors means that we are not tone deaf. We are also really plugged into the ecosystem in a way that allows us to amplify our proposition and to grow. When we're talking to investors in the last few weeks, there's opportunity. The conversation is quickly evolving towards, not less opportunity, but access. And how do we be strategic in how we deploy capital? So we sit in the ecosystem in a really nice way that allows us to thrive in the environment.
And I think this is across the board, right? Where concentration is vulnerability today, and the importance of redundancy, especially with supply chain and operations, has come to the fore even more. And the companies that seem to have a more diverse set of supply chain operators, suppliers, operations, etc., seem to be doing better than the ones that have concentrated single source solutions today. Fairooz, I'm coming back to you now, and we are talking about the current situation. Where exactly would you see the most reliant and the most resilient return pools today, and why? Is there a sort of math or formula to answer this question?
No, very relevant question, Shruti, and maybe first of all, let me refer to the word uncertainty, and it's we've heard it a few times on the panel. The reality is basically it's more and more becoming baseline, especially looking at this region and giving the current geopolitical situation. And I think Nader mentioned COVID, and before that we had a few other crises. It's true that things can shift quickly, as we've seen. Things such as capital flow, supply chain, customer behavior, and sentiment. However, I think what's key is the adaptability. If we are having adaptable ventures, adaptable VCs, adaptable investors who are able to react quickly to changes and who are able to pivot their models, I think the situation would be, normal and baseline. Now, also worth highlighting, and having said that, this region is very resilient, and we've seen it in the past, we've seen it now, and the region always comes back even stronger from any other crisis. We've seen opportunities created. We've seen opportunities created during COVID time. We've seen other kind of difficult situation where we've seen a change in client sentiment, and we've seen areas such as payment trails, embedded finance, compliance solution becoming more and more priority. We've seen the transformation, the digital transformation a couple of years back, and these are all opportunities which, of course, come up with a great pool of benefits for businesses. Now, to answer your why question, Shruti, and something which I've mentioned, the customer behavior changes very quickly, right? I mean, during crisis, we've seen how clients and customers change their behavior, and that's where the word adaptability really plays a role. And instead of just us sticking to the same way of doing business, things should be more fluid. Now, maybe bringing it back to SC Ventures here and referring to our themes. So our themes are focused on areas which we believe that they're critical in nature. To give examples here, our areas including, for example, trade, SME, digital banking, and digital assets are all resilient in nature. And we've seen how these areas and more are kind of necessary part of the fintech ecosystem. Now, maybe to conclude here and finally, before getting back to you, Shruti, it's also key to highlight the governance framework, right? And as mentioned by Benito, as SC Ventures, we provide institutional grade governance frameworks to ensure that ventures grow sustainably and focusing on longer term returns rather than just looking at the short term. Thank you.
Thanks, Fairooz. And just to push that context forward, and Nader, I'm going to bring you in for this one. How are you thinking about where to deploy capital today across direct opportunities versus fund managers? And what role at the back of that does that play in maintaining the entire systems, the entire ecosystem's liquidity and resilience today?
Thank you for the question. I think this is a very important one. What we're doing in this cycle is very intentional about where we're scaling and deploying. We're ensuring our allocation, especially to fund managers, remains and is prioritized because they're the most effective way to ensure the ecosystem has sustained dry powder and continues to deploy through cycles. By backing these experienced managers, you're effectively enabling consistent distributed capital into the market, and rather than, of course, episodic deployment that you get sporadically. It also strengthens the resilience that you have at the system-wide level because founders continue to have access to capital and the market doesn't become dependent on a few direct investors like Benito alluded to earlier with his backing from SC Ventures. And importantly, I think this touches on what Philip was alluding to earlier with this point number one, around international capital being a backbone of the capital stack in venture capital over here. Us backing and prioritizing fund managers over here serves as a signal to international LPs as well, because they look closely at local institutions and their capacity to continue to back the asset class. That provides signaling effect that's very important to address what Philip was bringing up. So for us, it's not about slowing down, it's about scaling the way that we reinforce both the liquidity question, but also the confidence in the market.
And can I ask as well, what gives you that conviction, Nader, that this market is still scalable, this market still has opportunities present today, despite the external conflict, despite what the numbers have to say?
I mean, it comes from a couple of places. Number one, structural fundamentals of the region. I mean, we're going through a series of digitizations in core markets, demographic growth, and increasing depth in the startup ecosystem. Another point that Philip actually alluded to was the deal flow, right? And the fact that it's becoming deeper is fundamentally something to keep in mind on a structural perspective. But equally important is the consistency of capital. Venture is a long-term asset class, and it requires investors who are willing to allocate through cycles, not just at the peaks. From an international LP perspective, one of the strongest signals is that they look for is whether local and domestic institutions are backing and remain to be committed into the asset class. And that's where we come into the mix, right? I mean, where government-backed investors play a critical role is exactly that. We're not just participants, but we're anchors of confidence in the asset class. So by continuing to allocate and increasingly through fund managers, we're signaling that there's not a tactical allocation, it's a long-term strategic priority in the region. And part of what Rola alluded to right at the beginning as well is this is an important part of the diversification play in the government strategy of the region.
Right. Thank you, Nader. Philip, I'll bring you in now. The first question is more of a question for the founders who have tuned in today, right? And also the ecosystem. What is it that the ecosystem now needs to do to support the founders? We've seen the numbers. We've seen that international investment, as you said earlier, we were very reliant on this international investment. But as we move to this phase of a pause and a caution, what can we do to support the startup ecosystem and to make sure that there's still activity, there's still movement in the space?
Yeah, look, I mean, and number one, I think things like this are amazing. So well done to the Standard Chartered Ventures team for doing this. I had been highlighting this for a few weeks now, that there's been a vacuum in the venture capital community of public discourse. So why did we publish the reports that we did? Because we learned in COVID, it's too late to make action in September and October and November looking backwards. And you need to take action now to be able to kind of best support yourself heading into what we're going to see as a summer and then normality come back in September. So I think that public discourse is extremely important. The second thing I alluded to was kind of founders need to make sure that they stay close to their VCs, share the pain points that they're basically having, because a VC will have a portfolio of 20, 30, 50, 100 potential investments, and they can aggregate. It's not about the individual founder's pain point, but the most common thematics that spread across those. And I kind of alluded to it, and in full transparency, I've mentioned this with Nader and other kind of fund of funds. The fund of funds then get the ability to aggregate the pain points that come from the venture capital entities themselves. So I think that being able to kind of explain the pain points, each one being a little bit different, but not solving for the individual, but for the collective, are some ways of taking action now to best support companies to be in a stronger position coming out of the summer. It's not really for me to advise founders how they run their businesses, but the only advice I can give, which I take for myself, and I think was alluded to by Benito earlier, is that like we did have to learn how to do scenario analysis, expect the worst and hope for the best. So really like expecting that things will be a difficult period. If you are looking to fundraise, conserve cash, cash is king, and hope that things as they improve, there will be winners out of this situation. You asked what kind of is this, the aim coming out of this. You'll see some companies will be winners, as we saw in COVID. AI adoption is likely to accelerate. Certain industries are slightly likely to benefit, but there will be those that continue to struggle. And from an ecosystem perspective, I mean, Nader mentioned it, and I'll just kind of mention what MAGNiTT's working on right now. We will be publishing DPI of all the funds here in the region, and we will be mapping out all LPGP relationships for investments in the region in an attempt to be able to create a dry powder calculation of how much capital is actually available in the ecosystem to deploy into startups regionally. And that is an attempt to kind of highlight some funds have actually recently closed funds. Others may have been fundraising, but what is the gap between the amount of capital that's being asked for versus the amount of capital that's available, so that that can then be filled, whether it's through regional LPs, international LPs, family offices, or corporates. And we'll be actually publishing a corporate venture capital report coming out soon. And in it, what role can corporates be playing to better support and invest into this industry specifically?
Great. Thanks, Philip. And we are going to be looking forward to that report. And it does look like there's going to be a reassessment of valuations as well on a grander scale. Benito, let me bring you in just for some on-the-ground references as well. We've seen a lot of disruptions over the course of the crisis that we've seen over the past 7 weeks. AWS outage, we've seen tech disruptions, we've seen critical infrastructure getting hit. Today, how did you go about navigating these tech and operation disruptions, and what's the business continuity and resilience plan in place just to make sure that this situation like this occurs in the future? We have a resiliency structure in place.
Absolutely. Your question goes straight to the heart of resilience, and Fairooz started talking about that earlier. Just to reference, go back to being part of a larger ecosystem and being institutional grade first. This was very well thought through. As a venture, as part of the ecosystem, we've had to build a fit for purpose BCP plan. Have we been impacted? Absolutely. But we happen to have resources around the world. We have servers in Ireland and South Africa, where we also have a massive operation. So we were lucky there day one. We were operational. The other thing was really accessing the ecosystem for support. What are they hearing? What are the validated sources of information? How do we adapt? Day one, we had access to Gautam, Fairooz, and the team to guide us through that, because we were actually new in the UAE. So having to lean on colleagues and the wider ecosystem was different for us, because we all know it. As a founder, building a venture can be lonely, but having access to a team and support system around you, what Philip was talking about, is not just one founder, is really staying close to VCs and the network. That has been of tremendous help. So we're very, very grateful for that. So having been backed by these systems, great. But the other impact we saw is we've had to delay our go-to-market plans for the UAE. We paused marketing. We need to go back and continue building and hoping for the right time to relaunch our proposition. But we do see, glimmers of hope coming through. And we're in touch with potential investors, partnerships as well. So we're very, very much bullish about the future. And as Gautam said, this region is going to come back, and it will come back very strong.
Great, thank you very much. And I'm soon going to take in the questions, the audience Q&As. But just before that, one open question for whoever wants to take this. We did speak a lot about international investment into the region and how that is proving to be a vulnerability at this point. However, how about capital, Gulf capital that's going outbound, right? And we've seen the role that Gulf money plays externally. And for the longest time, it was the US that was considered a key market, considering their deep pockets, their innovation mindset, etc. But today, given how things are so volatile and how things are changing so quickly, is there also a shift and focus from perhaps the US looking eastwards to Southeast Asia or other parts today? Is that something that we're seeing? And I ask this because we know a lot of the audiences today are family offices, sovereign wealth funds who have these allocations in the West. Anyone who'd like to take this? Open question for the panel.
I mean, I'm happy to as a data person, so that it doesn't need to be political. But I think that the US will remain one of the biggest markets for outbound investment. Inbound investment, 25% of all investment in the region came from the US last year. So that relationship, I expect, will continue to be strong. But at the same time, as we cover Southeast Asia, there's been a growing corridor that's been developed between Southeast Asia and the Middle East, partly because we've also noticed that Southeast Asia has been more isolated from the US, given geopolitics with China. And therefore, what you're starting to see is that Singapore, Indonesia, Malaysia, Vietnam, etc., have many similarities and differences to what the Middle East has, where you have a UAE, Saudi, Egypt, and the likes, and that there is a corridor whereby the same sovereign wealth funds in the GCC, sovereign wealth funds, GIC, Temasek, etc., in Southeast Asia. Both of them can benefit from stronger collaboration to see more exits. The primary problem that can be solved is an exit issue, whereby companies can either merge so that 1 + 1 = 2.5, and then become IPOable, which is ultimately part of the growth of the ecosystem. But let's not forget, India's around the corner. Pakistan continues to develop as a key partner here in the region. China continues to be a key player. So yes, while the US will remain a very strong ally and opportunity for investment, I think that the GCC sovereigns outwards as well as inwards will continue to collaborate into diversifying into other geographies.
Maybe if I can just chime in as well. One of the questions that was brought up in the Q&A box was around AI lowering barriers. And that's the other thing I wanted to allude to, in addition to what Philip was saying, is that innovation can happen anywhere in the world, and more it's becoming more and more democratic throughout the world. So losing out on opportunities because of whatever, an uncertain period of time means you're missing out on investable opportunities that are happening on the ground over here. And what I want to allude to is innovation is happening everywhere. The barriers to innovation are reducing, and where moats can be created, where value can be generated, comes down to what Mohamed was alluding to earlier. Is how do you engineer that serendipity, whether it's through concentration of networks, whether it's through partnerships, and you have that in this region. And I think it goes a long way to highlight that we're in an area where, like, if you look in the UAE, within 100 kilometers, you have a concentration of capital, of ecosystem that you don't have almost anywhere else in the world. And that's what I want to allude to is that's what creates ecosystems for development and growth and value creation to take place.
Thank you, Nader. Actually, I'm going to come back to you again because we have a question from an audience member, Brian Majani, who asks, from an institutional perspective, how are you balancing liquidity constraints in venture capital with the need for long-term alpha, particularly in emerging markets?
Maybe one thing that I think is worthwhile highlighting here, I think on an institutional perspective, it really depends on what does that institution look at in terms of success. I've heard a lot of institutions come up and they say they have hurdle rates, for example, and percentage hurdle rates. When you're in an asset class that really works on the J curve as a driver of returns, and what you alluded to there is alpha-driven returns in the long term, a hurdle rate incentivizes early liquidation, which doesn't really sit really well with this asset class. So one of the things I'd allude to is, how's the institutional structure, or the institution that's deploying capital, structured? Is it structured in a way that enables that institution to hold assets for longer? And that way, you're really taking advantage of this asset class that really pays off to hold on for longer. Or is it incentivized in a different way where it's pressuring its investment team to liquidate earlier in order to hit hurdles? So I think the makeup and the driving forces of motivation for the team goes a long way in first addressing whether it's the right asset class. And the second part of it is then why is that the right thing? Is it you're trying to diversify and realize different types of return? You want access to technology and being in the know? Is it to really look at whether it's an organization trying to enable that value creation from within? So is it a corporate-driven sort of investment vehicle? And is it creating unlocks and value through its corporate arm? Examples that we heard earlier as well, the way that SC Ventures is looking at unlocking value from the bank, for example. Are you as an investor also unlocking value beyond just the capital that you're providing? Because capital is abundant. It's that value added capital that really matters, and where you can drive your own returns profile even further with that value addedness.
Thanks, Nader. I have a question for, I think Fairooz might be best placed to answer this one. How does SC Ventures approach venture capital as an alternative investment class within a broader banking ecosystem? And how do you balance long-term illiquid innovation bets with the need for disciplined capital deployment? The question is from Nisha Salian.
So another very good question. And first of all, for SC Ventures, it's never alternative. It's a primary focus, and the way how we are positioned and uniquely positioned. We as a venture builder, of course, we build ventures, and globally so far since 2018, we've been able to build and deploy capital for more than 33 different ventures. But what makes that even more unique is the investment and strategic partners. So as part of our investment thesis, we've made investments and startups and fintechs where they provide services and products either to SC Bank or SC Ventures, and that's quite unique in the market now. For us, a good example to share here and very relevant example to share here with audiences, the reason why we decided 2 years back to expand into the region through the UAE. It's some of it's the ecosystem which exists here. It's beyond capital, because what we're looking at is not just return over investment or the return we get because of the investment. It's the impact, and that's how I've started the panel. The impact behind the partnerships and the contribution we give and we receive. There's something which we regularly use is that we have a role to play in building nation. And of course, commercials and investments and returns are a key aspect. However, I think what we're doing is beyond that. And that's why for us, investment does not look at how much money we're getting or how much returns we're getting in short and long term, but it's about what is the impact. And we have a systematic way internally to look at the right return through our investment committee and through our different governance frameworks.
Great, thanks, Fairooz. Next question is from an anonymous attendee. What should investors realistically expect in terms of time horizon to value creation and liquidity in today's environment, and how has that shifted? And I think, in a lot of the conversations we're having, time horizon seems to be a key element today. So it's an open question for all the panelists. Anyone who'd like to take this?
I mean, just data-wise, we've seen the exits used to be within 7 years for a startup being founded to exit, and that timeline has definitely been shifted towards a much longer period, closer to 9 to 10 years. So specifically here in the region, I alluded to it earlier, it's a pain point, and therefore In good times, you can boost M&A by building global trade visits and international attractiveness programs, IPOs. We published a report literally a couple of weeks ago talking about 12 IPOs that have been tech-backed ventures here in the region, and only 4 of them had positive returns. So I still think that there's room for in a 12-month period. So I think that exit window has been extended, but I can't speak to the value creation point.
Great. Thank you. Thank you very much, Philip. And I think with this, we are coming to the end of our session. Just when we have 2 minutes, I want to take the time to thank everyone who's joined us on the panel, as well as everyone who's joined us as attendees. It was definitely very, very insightful, and a conversation that I'm sure we are going to continue having as we see more alternative asset classes, adding more value to the ecosystem that we are, presenting more opportunities for investors, for family offices, for sovereign wealth funds, and institutions across the world. And the fact that the MENA region still provides a really lucrative option and opportunity for all of these global investors as well as the local ones. So on that note, I'd like to say thank you once again and hope to see you all again at a time when it's not as uncertain as the environment we are in today. See you then.
Thank you very much.
Thank you.